all about stocks. You're watching ET Now. Thank you so much for joining us and happy Diwali to you and your family. We're spending Diwali this year with Rashesh Shah. Rashesh, happy Diwali to you.
Hi, Faye. Happy Diwali to you and all the viewers.
Well, Rashesh, I want to take you back to the last couple of interviews we've done together. We spoke last Diwali and you talked about the fact that India desperately needs reform. You said if we get the right reform, the GDP would automatically go up 1 or 2%. Are you happy so far with what you've seen? Nothing much has changed on the ground, but are you happy so far with what you're seeing from our new government?
I think I was about to say the glass is half full, half empty, but I think it looks like 3/4 full and 1/4 empty. So I think a lot of things have happened. Even this weekend we saw quite a few announcements from the government. I think that the reform process is unfolding not as fast as people were hoping for, but in a very calibrated manner. So I'm happy, and I think from where we were a year ago to where we have come, things have improved significantly. I think because of the government, but also otherwise from the macroeconomic point of view. So India is in a very good place right now.
So are you also of the opinion that we're looking at the largest bull run the market has ever seen, or at a really long-term bull run, at least from where we're looking at it now?
Yeah, I think it's we should always be careful about calling something the largest bull run, or because the magnitude is always very hard to. And we have had some great, historically also some great bull runs in the market. I think 2004 to 2008 was a great bull run in the market. I do believe that the next 3-4 years, as economic growth comes back, where we have had a slump for the last 3-4 years, so things are starting to look good, and with the government reforms, with the macroeconomic stability, corporate earnings will start picking up, and usually the stock market returns are directly a function of corporate earnings growth rate. Next 3-4 years I feel very optimistic about, and I think India's economy is coming back on track.
In fact, the last time we spoke, you particularly talked about GST. You said GST alone will be able to, improve our GDP by about 1%. We've not seen too much on that front yet. Are you a little disappointed by the fact that these key things have not come up yet?
Yeah, but it's also unfair to expect them to happen overnight, because there is so much work in the background to be done, and these are just structurally such important things that you don't want to hurry through and do a half-baked kind of a job. So it's been about 6 months of the new government. I think the commitment is there, and I'm hoping it will come. But I think what is interesting is what you said, that even now there is so many low-hanging fruits, and each of them can give you 30-40 basis point of GDP to 100 basis point of GDP. So 0.5%, 1% GDP increase is available to pluck. So as this government unfolds the reforms and keeps on doing that, I think getting to 7% GDP growth rate, it structurally looks very, very possible. Above 7, you'll have to do a lot more, but even the ones which are easy to do, which are on the anvil, will get us to 7%. And that for India should be, I think, the middle of the road kind of an achievement, that if we can't grow it between 6 to 7%, then we are truly underperforming.
Well, there is this whole question now about whether interest rates should come down first or the economy should improve first, and which one is going to happen and when. What do you foresee right now? We know that corporate numbers are slightly starting to look better. Tell us how you envision the rest of this financial year.
Actually, I'm one of the few guys who believes that corporate earnings and interest rate don't have a direct correlation. They are both being affected by various independent factors. I think interest rates should be, and RBI has been very clear about that, will be affected by inflation outlook. The good news is inflation outlook is coming under control. I think inflation is starting to fall. The recent oil price fall was a very big boon for India. So when we add all that, the currency has been stable. We think inflation by the 4th quarter of this year, Jan, Feb, March, inflation will be truly under control, and that is when we expect RBI to declare victory in that sense. On the other hand, the corporate earnings will be a function of the demand uptick, the investment demand and the consumption demand. That has been slightly muted. Even now we're seeing consumer sales and all are still fairly muted in consumer goods. So that also we expect after Diwali onwards, it should start picking up as the confidence in the economy starts taking off. So corporate earnings will be largely driven by investment and consumption demand, while inflation will be the key determinant for interest rates.
Okay, so tell me this then, when you're looking at the market at this point, do you believe that, and I remember the last time we talked, you said get into the market, get in regular, invest small amounts at a time. Should we just continue doing that and look maybe at the next 5 or 10 years?
Absolutely. I always believe that, especially if you invest when there is a gloom doom, you might end up getting a long-term return of 18-20%. If you invest on an average basis, that you invest through good times and bad times, I think getting 15-16% also is possible, which on an after-tax basis is still, I think, one of the highest returns you can get. But for that, you need to take at least a 5-10 year view. You can't take a 3-6 month view and invest in the market, because the market can correct. And right now there are a lot of global factors which might force the market to be subdued if you take a 3-month view. But if you take a 3-year view or a 5-year view, I think the market is giving you, I think, 15-16% return on an average. And if you're smart, where you can be counter-cyclical, where, as you remember when we spoke a year ago, I think there was gloom doom in the market. People were giving up on India, giving up on equities. If you have the courage of conviction to invest at that time, I've seen investors make 20 to 22% kind of average returns also.
Okay. We've seen a series of state government elections come and go where the BJP just seems to be getting more and more powerful. Our market has always reacted positively to this sort of information, but tell us from an investor's point of view, what does this mean for the ease of doing business in a state like Maharashtra? What does this mean for our economy in general?
See, I think one is, as you rightly said, as BJP has been always perceived as more investment friendly, business environment friendly. And then secondly, you have our current Prime Minister Narendra Modi's approach in Gujarat. So a lot of us are extrapolating that what the approach he undertook in Gujarat to make it one of the fastest growing states, one of the states where it was ease of doing business. And ease of doing business, as you said, is one of the most critical things in India, because it's currently still very hassly to do business. I mean, when I see companies and entrepreneurs and all, you really have to be very tough to do business in India. It should become easier, because we are not adding any productive value by making it harder for companies to do business in India. So it is both actually BJP and Narendra Modi, I think, because of which this expectation has started to build up that India will get easier place to do business in.
Alright, so if India is an easier place to do business, it's possibly a great place for you and I to invest in. When we come back, we'll talk about specific sectors and advice to investors like you and me. Don't go anywhere. Welcome back. You're watching All About Stocks on ET now. Thank you for staying with us. Rashesh Shah spending Diwali with us this year. Rashesh, I must remind you, we spoke in January 2013, and you gave me a list of sectors that you believed will do well. You said pharma, FMCG, private banking, and cement. 3 of those have actually really paid off. I want to ask you about cement. And generally, the commodity prices have been going down across the world. But for those of us who are invested in the cement sector, based on your advice, what would you like us to do now?
I think cement stocks have also gone up a lot, and as you said, the earnings growth has not been there, because largely cement is also driven by economic activity, construction, infrastructure development. And I think the last year and a half, all of us have been wrong on the infrastructure sector in India. But I would still say, I think cement, because of a couple of reasons. One is there are a lot of entry barriers. The replacement cost of a cement plant now is a lot higher. So it's going to be a lot more expensive for somebody to add fresh capacities in this. And B, it is one of the few sectors which is not a global sector. It's a very local sector. You can't import cement because the freight cost is too high. So as a result of that, as India's growth picks up, as India construction activity, infrastructure building activity picks up, the current capacity that is already there on the ground will become fairly invaluable, because this is going to be hard to replace or very expensive to replace. And I think IT, pharma, all of that we still feel very bullish about, because all these are great companies. They have been competing in the global market, have proven themselves, and fortunately US economy is doing very well, and a lot of IT and pharma companies, for them the US market is a big market.
Tell me about private banking. And when you said in 2013 that private banking was going to be really important, it really paid off for those of us who took that advice. Going now into the next couple of quarters, where you do believe the RBI will triumph over inflation, is this a good time to add private banks to our portfolios, or to keep adding more and more value, more and more stocks of private banks?
Absolutely. We do think that financial services, especially banks, is a structurally large opportunity in India, because if the India story is going to unfold, if India economic growth is going to happen, the banks will play a very large role in that. And the private banks are especially well positioned, because if you look at the government-owned banks, they are currently handicapped by two issues. One is the issue of asset quality, NPLs and all that, and the other, recapitalization. They need a lot of recap, a lot of investment from the government. So these two things are still hanging over them. The only good news is that all this is in the price, and that's why the government-owned banks have not done as well. So you can argue that how much worse can it get? But I think investors will still favor private banks over government-owned banks, for the simple reason that the story is very clear for the private-owned banks. I think for them to grow at 20 to 30% a year, even if India continues this 6 to 7% GDP growth rate, it's fairly easy. They will be able to raise a lot of capital. They're already fairly well capitalized. They'll raise more capital, and fortunately they have been able to keep the asset quality issue under control.
So tell me this, I want to ask you about a couple of the reform measures that we've seen. Make in India, and we saw the Prime Minister walk the talk as far as labour reforms are also concerned. It's something that they're actively looking at. Do you believe that the focus now, even for investors, should move towards manufacturing perhaps? Do you think the push will be enough?
See, here I think it's important to see what is good for the economy as a whole and what is good for investors. Currently, we expect a lot of investments will happen in manufacturing. A lot of those manufacturing companies may take some time to come to the market, or become so the existing manufacturing companies will become invaluable. As I said, cost of land, the replacement cost of most of the good manufacturing units is going to be prohibitive. So as a result of that, because of high inflation in the last few years, so the existing manufacturing capacity, absolutely, I think it's a good sector for investors to look at. Investors are already looking at it, but manufacturing is not just one sector. There are many sectors in that.
So how do we choose in that sector? Give us a checklist of what to check about these companies before.
If you ask me, my bias is always about management quality, because I have seen again and again that when you have good quality management, even in industries which are struggling, even where industries have headwinds, good management quality always triumphs. So and you say, what is good management quality? How does an investor assess that? Through the track record of the management, through communication of management, because most of the good companies now communicate fairly often with investors, and through just the corporate governance practices that are adopted, including small things like who are the auditors, who are the board members, all of that. They are all signals that a company gives to the investors to assess what is the quality of the management in the company. So a track record is very important. I don't know investors to invest in any company that has not been in the market for at least 5 years, at least retail investors. Institutional investors can do something different, but I always believe retail investors can wait, and some companies which have been around for 5 years, then you have a reasonable track record to assess of those companies, corporate governance track record and practices, and just the communication that is coming from the management team. These are good ways to assess it, and that is always going to triumph over just industry, because in the same industry you can have good management and bad management.
But if you look at a combination of like a Venn diagram of labor reform, increased domestic consumer demand, and good management, I think of the auto sector. Do you think that there's value in our auto sector right now if all of these things work out as planned, where labor becomes easier to manage, where consumer demand starts to pick up again? Do you think that our auto sector might take off, both two-wheeler and four-wheeler?
Absolutely. I think as you correctly said, out of those three things, currently consumer demand is the one that we've been holding it back. The auto consumer demand has been very slow to pick up. I think corporate governance and management quality in the auto sector has been of a very high quality. Almost all the companies that are there have shown great track record. And I think the union issues also for a few companies in a few states also has been an issue, but if that comes under control. But of the three, I would say for the auto sector currently, consumer growth, the demand in consumer growth is a key parameter to watch.
Well, One of the good things that this current government had inherited from the previous UPA government was that fuel price deregulation had already begun. So they inherited that regime, and all they had to do was just continue it. Is this the time for the government to now completely deregulate diesel, and how do you foresee that will impact the oil marketing stocks that we have available to us right now?
I think that time has come, as you said, that there is a clear roadmap, and I always believe this government is also been fairly fortunate, but you have to be good and also fortunate. So I think the earlier government also gave a lot of easy things for this government to do. They have been the global markets have been stable, the global liquidity has been good, the rupee currency has also been fairly stable. Fortunately, the rainfall also picked up in the end, because there was a scare in between about the rainfall, and now the oil prices have fallen. So I think there are good things happening for this government and for India. And on that, I would completely agree with you that the outlook on this at least looks good for the government to deregulate diesel. It will be good for the oil market, especially the government-owned oil and gas companies, because for the last about 7-8 years they have been weighted under by becoming instruments of the government approach to social programs. In a way, the government wanted to keep a fuel price subsidy, and they bore the burden. So the government was expected to pay them. They actually bore the burden of that. So I think that burden going away, investors will, and they are owned, a lot of the government-owned companies, the government-owned oil marketing companies. So there will be good news for them.
I remember your one piece of advice the last time we talked was the fact that if you're investing for the first time, stick to large caps. Since then, and if we look at the market now, would you say a lot of the large caps that the top 50 stocks at least have run up a fair amount? So if I'm investing for the first time now, should I still be buying the large caps at these values?
I would still say a large part of your portfolio, if you end up buying HDFC banks and TCSs and ICICI Bank, you are still okay, because they are good companies, they are large companies, and there is a lot more I think awareness about them. So I think from that point of view, and there is a fair amount of liquidity. So but now I think, given the environment is a lot more positive, you can invest some in the small cap, mid cap sector. But again, as I said, provided the earlier caveats that at least a 5-year track record, good quality company, and obviously earnings growth rate coming in. If they are available at a good price, I think they may also not be bad, but it should still be 80% toward the large caps for first time new retail investors.
Alright, we're going to take a very quick break, but when we come back, we'll talk about other investment options. We'll talk about insurance and gold and some interesting ideas this Diwali. Don't go anywhere. Welcome back. You're watching All About Stocks on ET Now. Thank you for staying with us. For those of you who just tuned in, happy Diwali to you. We're spending some time with Rashesh Shah this Diwali. Rashesh, there are obviously various other options for investors other than just equity. One of those is gold. And I don't think we've had a Diwali where gold had been beaten down this desperately up till now. And while there is, the token amount of gold will always be bought during Diwali, do you think it makes sense to invest in gold at all at this point?
I think for the last at least a year, we have believed that gold as an investment story is not attractive anymore. So gold consumption demand is always going to be there, and I think Indians will always consume gold. So that consumption demand continues in the market also. But I think investment demand, I think globally and in India for gold is going down as as inflation has come down and your real interest rates have become positive. Any hard asset is not going to be as attractive. So I would believe that gold as an investment story is not very attractive anymore.
Alright. The other thing to look at obviously is the debt investment, and everybody's been saying that this is the point to get into equity. But if you're looking at really long term, if I'm looking at a retirement that's 30 years away from now, what should my breakup be of investments?
I think if you have, you are very fortunate at this time that equity and debt, they both look attractive, because as I said earlier, inflation is coming down, interest rates are expected to come down. India still has one of the highest interest rates in the world, and if economic activity is to pick up, interest rates will come down. And the new government, as the reforms unfold, as they make it easy for the supply side on a long-term basis also inflation structurally could also be coming down. If that is so, then being in bonds or being in fixed income on a long-term basis would also not be a bad thing. So we are also advising investors to buy fixed income investments, but of a long duration, not of a short.
Quantify long duration, would you say?
I think 5-year bonds, 7-year bonds. A lot of institutional investors are buying even 10-year bonds also now. So I think to buy 3 months, 6 months, 1 year kind of fixed income investment is not going to be. You'll only get yield. You may not get the capital appreciation.
Does it make sense then for me to buy a long-term debt mutual fund and
Absolutely.
have the fund manager do all of that worrying?
Absolutely. I think it makes a lot of sense. I think it makes sense for equities also. I think I've always believed that there have been so many good equity mutual funds in India and so many fund managers with great track record that if you just want to invest if you want to get a higher than market return, finding good mutual funds and just investing in that is the ideal way to do. They'll do all the hard work for you. Unfortunately, for a lot of investors, they don't get the same excitement of owning a mutual fund as you get from owning a stock. I bought a stock at 40 rupees, it becomes 140 rupees. I feel personally associated with that stock. But if I buy a mutual fund at 18 rupees NAV and the 18 rupees become 36 rupees in 3 years, there is not any excitement in that, because mutual fund is very unglamorous as an investment for retail investors, but it actually does a lot better, and from an effort point of view, it's a lot easier to invest in that.
Okay, so also tell me this now. If you're talking about using mutual funds, on the other end of the spectrum is unit-linked insurance plans, and you have insurance products now within Edelweiss. There's always been an argument that these products are not efficient, that the costs are too high, that the regulation is too stringent, so the guarantee will cost me, it will bring down my possibility of return, or the fact that I'm being forced to buy an annuity at the end of my pension. So tell us if you believe at all that as investors we should consider investment-linked insurance products, or should we just stick with mutual funds at this point?
I think as you would have seen in the last few years, IRD has changed a lot of costing and pricing policies on ULIPs. After that, I think the ULIPs have become very attractive. So the criticism that was there of being very expensive and a lot of cost in that was true maybe earlier. But in the last 3 years, IRD has changed the pricing norms on ULIPs completely. On that basis, I think if you invest into ULIPs, if you have anything more than a 3-year horizon, then in the longer term, ULIPs are as effective from a cost point of view as a mutual fund, maybe even more cost effective the longer you hold them, because in the ULIP the asset management fees drop significantly for the more period that you hold. So if you hold something for 5 years or 6 years, you might end up paying asset management fees that could be half of the asset management fees that you pay in the mutual fund. So if your investment horizon is under 3 years, then a mutual fund is better. If it's above 3 years, then you might want to look at the unit-linked policies also, because they become more efficient for those kind of investments.
Well, Rashesh, it's Diwali time and I'm going to demand a gift in the most ungraceful manner. Give us an investment idea that you believe, if I am a long-term retail investor looking at all of these avenues available to me right now, give me advice on what to do over the next 1 year.
I think, as I said, you are spoiled for choice right now, because except commodities, which I don't think currently, because all commodity, agri commodities, gold, the prices are softening. The trend is clearly there. Both equities and fixed income will do well. In equities, I think if you can't buy anything and you don't want to make a lot of effort, I think buying the private sector banks. There are about 5-6 of them which are listed and fairly. Just buying the private sector banks might be an easier way of really playing the India story in a holistic way.
All right. And last question, obviously we noticed from when we walked into your office that there is some sort of giving back happening at Edelweiss this year for Diwali. Tell us a little bit about what's going on.
We always encourage employees, because I think at least we all in the financial sector have been beneficiaries of the India growth, and compensation, salaries, rewards have increased a lot. And what we find is, from time to time, I think getting employees to think about giving, and not just giving cash, also giving their time and effort, is what we encourage. So we encourage a lot of our employees to work with NGOs. So we have an Edelgive Foundation that channelizes our own money, what Edelweiss gives and what our employees give, to a lot of NGOs. We support a lot of NGOs in the education and the employability sector, and we find it very energizing for our employees. A lot of our employees, even small amount when they give, I think the habit of giving, the feeling of contributing and making somebody's lives easier is also a very positive feeling, and we see that a lot. So the amounts are not important. The fact that you give a little bit is very important.
All right, Rashesh, happy Diwali to you and all of your employees. We hope you have a wonderful year ahead. And thank you so much for spending time with us.
Thanks a lot, Faye, and happy Diwali to you and your viewers.
All right, so that's a wrap on All About Stocks. Remember, you can reach us on the email ID or the Twitter handle. If you have any questions for Rashesh, we'll ask him to answer your questions for you. Happy Diwali to you. Thank you for watching.